My name is Tony McLaughlin. I'm from Citi, and I work in the transaction banking part of Citi. My role is emerging payments and business development, which essentially is, my role is to try to figure out what's new in payments and what does it mean from a Citi perspective. I'd like to say up front that we have basically sold our acquiring businesses. So in a sense, we don't have a dog in the race. What we do is, and what I do is I interact a lot with financial institutions and larger corporations and fintechs on a global basis. And so what I'd like to do is to share our observations of how we see the payment acceptance market developing. And we've made one, we think, a positive contribution. I'll tell you what that contribution is, and then I'll unpack how we got there to see if it makes sense. So what we've built in combination with a bunch of merchants and fintechs and banks and the Berlin Group and SWIFT is an API specification that enables any financial institution to offer an installment loan product on a digital platform. So essentially what we've done is provide a standardized way for issuers, if you like, for banks to provide a service that looks like Klarna or Affirm or Afterpay or PayPal Credit. And we've done that for some very specific reasons that I'd like to go into. And one issue that I think Peter talked about before and alluded to greatly was this question of cost of payment. And it's certainly true that when I talk to merchants, and again I'll express that we generally talk to the larger merchants, the subject of cost of payments is beyond the boiling point for absolute sure. Whether it's at Money 2020 or in one-on-one discussions with these big guys, there's an enormous sense of frustration and even bordering on contempt and hatred. So, to your point, Peter, about the industry displaying rent-seeking behavior, I think that's absolutely true. You just have to look at what's happened to scheme fees in the past couple of years. So that's certainly a place where we need to look into it, but in a sense, there's a much, much bigger issue at stake, which is if banks are disintermediated from the lending relationship, then the banks are dead. As was discussed before, lending is 60% of bank revenue. And where we're going to get to is this choice, where a bank will have to choose between, do I try to protect the interchange and the payment revenue, or do I try to protect the lending revenue? And I would say for the first time, fintechs and non-banks are starting to threaten that core lending relationship. And that's particularly true if you look against this macro background. And this is a McKinsey study that looked at $80 trillion of economic activity going forward, resolving into digital ecosystems. And I think one observation is this, which is, isn't it strange that really on these digital platforms, the only instrument that banks have got to deliver balance sheet into these digital platforms is through the credit card? It's the primary way that banks deliver balance sheet into digital platforms. And don't get me wrong, I mean, let's face it, Citi is one of the biggest card issuers on the planet, so we like credit cards and don't want to see the model disrupted. But credit cards are a bundle of services. As you mentioned before, it's payment, it's credit, it's loyalty, it's insurance, it's consumer protection. That whole bundle is there, and that bundle doesn't serve every single set of needs, as you said, from a Klarna perspective. So we say one thing, which is a very positive statement, which is these digital ecosystems need credit. From an affordability perspective, iPhones cost over $1,000. Apple need affordability solutions for the iPhone. If you look at Apple, for example, they've gone around the world and plugged into more than 100 lenders and made proprietary connections to 100 lenders to make iPhones affordable. So they have a need, and customers have a need to buy iPhones, which is not served by the credit card. So these digital platforms need credit. And there's only 3 places the credit can come from. There's only 3 places. There's only 3 solutions. The credit can come from the bank, or the credit can come from a fintech lender, or the credit can come from the platform itself. And the scariest of those 3 is the credit coming from the platform itself. You know, last year, Ant Financial loaned $95 billion to consumers. So that's an example of the platform doing it for themselves. They originate the loans, they've got the customer relationship, they do asset-backed securities on the back end, so this stuff is not staying on their balance sheet. And they are disintermediating China Union Pay and each of the 200 banks that they've plugged into, they've got direct connections into. And that's the nightmare model, and that's a catalyst, because you better believe that the big West Coast tech players notice that as an example. And you should also look at, for example, and this is public, Amazon have a seller lending program with Bank of America in the US. You know, Amazon decide who to lend to, decide how much to lend to, and Bank of America is the dumb balance sheet on the back end. So banks are in an extraordinarily precarious situation. If you believe that economic activity will move on to digital platforms, those digital platforms will embed financial services. They will embed financial services, and the question is, who will provide those financial services? One of those financial services is payment, and one of those financial services is credit. Who will provide those services? And that's the real battleground, and it's an existential threat for the banks. So look, banks have got a bunch of problems. You know, we might think that it's like 2 minutes to midnight for high street retailers, but actually it's 5 minutes to midnight for the banks if the banks allow themselves to lose the credit relationship with the consumer. And to the extent that Klarna and Afterpay and PayPal Credit and all of their many competitors and imitators are successful, the bank is losing 2 sources of revenue. It's losing the payment revenue, and that's painful, but let's think about it. In markets like the US, lots of the interchange gets given back to partners anyway. So it's painful to lose interchange, but it's not existentially threatening. Losing the lending revenue, the lending is 5 times bigger than the payment revenue. So that's what's at stake. So you're seeing here a confluence of, if you like, needs. The banks need to maintain the lending relationship, but the only tool that they've got for delivering balance sheet into digital platforms is the credit card, and that's a bundle of services that does not meet all needs. But it's the only tool they've got. And then you've got the merchant aspect, and I think as we all recognize, retail is tough, e-commerce is tough. It's an absolutely brutal area of competition with low barriers to entry. And finance is an absolutely critical component to being able to sell more stuff. So when I spend time talking to merchants, and a lot of the discussion goes on to cost of payment, and as heated as that conversation is, there's something that they care more about, which is selling more stuff. And I think if we look at the business models that are emerging with the fintech lenders and how they inject balance sheet into these digital platforms, it's not about cost of payment, it's about selling more stuff. And I think it points very interestingly to new business models for banks and for fintechs and for acquirers. And the question is this, for an acquirer, and I think we have to move away from these definitions of what business that we're in. If you think that you're in the cards business or the payments business or the acquiring business, that's not what business we're in. We're in the business of enabling business to take place and of enabling commerce to take place. And one of those functions is delivering balance sheet into digital platforms and delivering balance sheet into merchants. So we see a confluence. The merchants want to sell more. The banks want to survive. Open banking has the potential to be a complete white elephant. I think, Peter, you raised the prospect of this really scary, credit transfer model emerging and being a real threat. But the fact is that we all know the big merchants absolutely reject the model where you have to, go through a redirection and then a crappy, strong customer authentication process out of the checkout. So the merchants will not accept it unless the friction goes away and some of these other services are added in. And why would any bank deliver a good, strong customer authentication on open banking or PSD2 when they can't make any money from that transaction? So our contribution is this, which is banks are at the very beginning of the deployment of APIs, the very beginning. And banks will have APIs for retail banking, and banks will have APIs for wholesale banking. And here's a very big question. What will those services be that they deliver through APIs? And will those APIs be standardized or proprietary? If you leave banks to their own devices, they'll do proprietary APIs which are around the edges. And what we've suggested is that banks must deliver core banking, and a bank is a balance sheet. Whether you do auto loans or mortgages or savings or whatever, a bank is a balance sheet. Banks must deliver balance sheet through API. And if they are to deliver balance sheet through API, they should learn the lessons from the first wave of electronic banking, where they built proprietary systems. And they should build standard APIs for delivering balance sheet. So that's exactly what we have collaborated with merchants, fintechs, banks, Swift, and the Berlin Group to build. This is nothing proprietary, Citi. All that happened was this. We observed what was going on around the world. We observed the catalysts. We observed what was happening with Ant Financial. We observed what was happening with UPI in India, with the rise of the fintech lenders, with open banking, PSD2, and real-time payments. And we said, banks are stumbling into a really bad outcome because the approach for the banks in the UK and Europe when it comes to PSD2 and open banking is doing the absolute minimum and a compliance mindset. And if that's the way that banks approach APIs, they are going to be dead in the water because they're going to lose that lending relationship. So we imagine an interaction like this, which is you're shopping on your favorite e-commerce website and you're at the checkout. There's two new methods of payment. One is the method of payment which is driven by open banking, or PSD2, which is pay by bank. You click on the button, you are authenticating with your bank, and you pay from your checking account. That's version number one. We want to standardize the second option, which is pay later by bank. Now, what is the advantage of pay later by bank? The bank is lending to its own customer. So we'll have a better assessment of the creditworthiness of that customer. The bank is lending to its own customer, so there's no clumsy onboarding process. The bank is making money from that transaction. And because the bank is making money from that transaction, they have an incentive to deliver a good, strong customer authentication. So here's what I'm talking about, which is if it's the choice, and it will soon become the choice of, do I die in a ditch to protect the payments revenue, or do I die in a ditch to protect the lending revenue? You need to protect the lending revenue as a bank. And so that's why we're encouraging, and this is completely open, anyone can join this initiative. We're building an open standard for pay later by bank. Pay later by bank. Now, look, there's 10,000 banks who are members of SWIFT. There are 11,000 banks who are members of SWIFT. If all of these banks publish this API, which will be quite difficult, and I'll tell you some of those challenges, then There's going to be a bunch of APIs out there. So there's a great scope for this to be intermediated. And we do already have, at the SWIFT meetings, we've got a bunch of fintechs who are seeking to be PISPs for pay later in the same way that there are PISPs for pay now. So anyone who is an acquirer can look to becoming a PISP for delivering bank balance sheet into merchants. The standards are more or less ready for publication. Version 1.0 is more or less ready for publication. If anyone is interested in participating in the standards now and going forward, then let me know. I'll put you in contact with SWIFT. Again, it's not Citi trying to sell anything. You can have access to the API standards and contribute to this. And this is just the beginning. Again, that bundle of services that are embedded in cards, payments, credit, insurance, loyalty, customer protection. Really, our macro picture is this. This bundle is being disaggregated and will be redelivered through APIs. And we need to drive that as an industry. Because if we don't drive that as an industry, then the business will go to the fintech competitors to banks. And that's all fantastic, but don't blame us for trying to respond. So look, this is what I generally see, which is, there's the issuers and the merchants are really not meeting eye to eye at the moment. There's, especially on the merchant side, just a kind of complete rejection of the model. One thing that the cards industry needs to do is look at the prices. It's a great service, but the price is just too high. You're creating oxygen for the alternatives to be created. And just look at what happened with the Visa debit fees in India. Visa, because of the presence of substitutes, Visa had to reduce their pricing by 95% in India. So we need to think very carefully about what's happened to the scheme fees. But irrespective of that, we think our macro picture is this. We think cards will grow. The world of e-commerce is going to go. Cards are going to grow, but banks are also going to go online through APIs, and most of those APIs should be standardized. And Pay Later API is just one example. There's going to be a bunch of other APIs which incorporate insurance and loyalty and other services which are wrapped up in that credit card bundle. And acquirers, or people who are in the card space, should embrace this and create a hybrid model, because actually, again, our core business is about making commerce work, making the merchant successful. And I think that will be delivered through a hybrid of existing and new rails. I'll leave it there.